Well, good morning, everyone, and welcome to our webinar, How to Develop a Financial Roadmap. It's fantastic that you could join us today. My name's Sue Hurst, and I'll be your MC for today. So, planning for the finances in a business is one of the most important tasks, but one that many business owners aren't that conversant with. So, that's why here at CFO On Call, we've developed this plain English session to simply explain what's involved and why it's vital to have a plan for both profit and cash flow. Just before I introduce Ashley, I'll explain some housekeeping. If you've got questions that you'd like to raise, if you'd like to type them into the panel on the right-hand side of your screen, and I'll read them out to Ashley as we go through. I'll keep you muted today just to keep the background noise to a minimum. And at the end of the webinar, we've got a special offer for you, and you'll receive a free template of the tools that we're going to show you today. So our presenter today is Ashley Arnott, who's an experienced commercial accountant and business advisor. Ashley's worked in a variety of industries, including environmental, biotech, building and engineering, manufacturing, wholesale, and retail. Ashley's spent many years helping businesses just like yours to maximize profit and cash flow and create real value for business owners as a partner of CFO On Call. So without further ado, welcome Ashley.
Thanks, Sue. Okay, as the title suggests, we're going to talk today about how to develop a financial roadmap for your business, which, as the title suggests, is critical if you not only if you want to survive, but if you want to grow and remain in control. So, as an agenda for today's session, we're going to talk about the budget and give a bit of an overview there. Then we're going to look at the differences between a profit and loss budget and a cash flow forecast. Then we're going to go through a bit of an example of a simple budget template. And the second half of today's presentation is about the 7 key financial drivers of your business and how to use these to maximise your cash position. So I'll just start today with a bit of a case study. And it's 4 or 5 years old now, but we continue to use it because it's still very typical of what goes on out there in the business world. And it was a company that had been operating for about 2 years. They had a temporary overdraft facility with the bank, and they were in a bit of trouble. They were called in by the bank, and it was found they had no budgets or forecasts, and they were actually trading at a loss. And this is where we got involved. What we did, we obtained information of their latest profit and loss and their cash position. We developed a profit and loss budget and a cash flow forecast for them for the current year. And what happened after that was they were able to pay off their temporary overdraft fairly quickly, within a month or two of us getting involved. Critical to that was the organisation of an ATO payment arrangement. And in time, we applied to the bank for a permanent overdraft, which was approved. And some of the important factors which led to this was a reduction in labour hours, changing of some suppliers to get some better prices. The end result was they were profitable within 3 months. They understood the importance of keeping the bank informed and the importance of constant review and cash forecasting. And also another thing which helped this particular case was quick job billing and follow-up with customers. Now, that's just a bit of an overview. Just to explain that, central to the turnaround of this business was the profit and loss budget and the cash flow forecast. Firstly, because banks are likely to want to see one when lending to you. But secondly, because these two things are critical to be able to remain in control of your business. Okay, types of budgets. Today we're going to talk about the two main elements of the financial budget, being your profit and loss budget and your cash flow budget. Depending on the size, the type of business that you operate, the complexity of these budgets will vary quite significantly. Just on the right-hand side here, we've got the profit and loss budget. For example, if you've got a fairly small or simplistic business, you might just have one budget which combines everything. Or if it's a bit more detailed, then you might have sales, marketing, personnel, manufacturing, or overhead budgets, a combination of these, or even some businesses have many more. Um, and what they are typically is more of an operational plan, but still broken down quite detailed. Now, what many businesses already have a sales and marketing plan, for example, and by that I mean who your target customers are, how much of each product you're going to sell to them, example. But what they don't do is they don't quantify it properly, and they don't link it to their profit and loss budget. And by linking these into your profit and loss budget, you're able to compare your actual results against your plans um, more appropriately, which in turn gives you, a powerful tool to make some important decisions. So, a budget's not something just is not a static thing. It's something that you should be able to use in your business to actually control your business, but also make decisions about your business going forward. So why set a budget? First and foremost, it acts as your roadmap. And by that I mean, if you need to go somewhere and you know the destination, but you don't know the directions, you wouldn't just jump in your car and drive. You wouldn't just drive out of your driveway onto the road and go left or right at a toss of a coin. Yet, this is what some businesses do. They know they want to make a big profit at the end of the day, but they have no plan or real idea on how they're going to get there. And what your budget is, it's your GPS or your street directory on how to get there, complete with road signs and speed camera warnings. And by speed camera warnings, I mean just as when you drive along in a car, you don't go 200 k's an hour. Same within a business, you don't just go all out for growth, because you need to sometimes temperament that so that it's you can do this sustainably. All right, some other things there which are reasons to set a budget. Secondly, it reveals waste, aligns priorities, reduces stress, it builds new habits. Hopefully it will act to control spending. It develops a sense of ownership within your team and coordinates efforts within your team as well. It improves productivity from a sense of awareness. It acts to accelerate your financial goals, and it provides a base from which progress is measured and allows you to focus on your key issues. A cash flow forecast. What this is, it shows your cash position on a weekly, monthly, or sometimes even daily basis from some businesses. It differs from your profit and loss budget due to a number of things. Firstly, timing differences between your income and expenses. So by that, it's the difference between when you actually incur the expense to when you have to pay for it, and also when you actually make a sale to a customer compared to when that customer pays you. So when you actually make a sale, for example, that goes in your profit and loss budget. When the customer is actually going to pay you, that goes in your cash flow, which may be many months apart. Other reasons there, some of these factors are things that are not in your profit and loss budget but are in your cash flow forecast, such as loan receipts and loan payments, or lease and hire purchase payments. Some things such as tax payments are not in your profit and loss budget in the same format as they're in your cash flow, such as GST or PAYG withholding. You've also got superannuation payments, which go in at different times. Capital expenditure, for example, is something that is not directly in your profit and loss budget, but is in your cash flow forecast. And dividend payments to owners, again, not necessarily not in your profit and loss budget, but are in your cash flow. Why prepare a cash flow forecast? It helps you understand your cash peaks and your troughs. It helps you understand issues before you run short of cash. And you really should do a forecast to know when your cash flow is under pressure and take proactive measures against that, whether it be on a weekly or even a daily basis. It also helps you decide the best times to buy stock or equipment. It helps you decide when to pay suppliers or dividends, and it helps you decide when to place surplus cash into high interest accounts. And as businesses grow, even profitable companies can run into cash flow problems. And by that, I mean, when you make a sale, or as your sales increase, typically the costs associated with those sales will increase at a rate which is even more than, sorry, start again. So when you make a sale, the costs associated with that sale, you need to pay for that sometimes before you make the sale, or sometimes before you get paid. And as your sales increase, these costs increase also, and these costs can increase at a much faster rate than what the sales receipts do. I'll explain a little bit more about that in a cash flow diagram shortly. Oh, go back. Sample template. So we're just going to have a look now at a couple of templates. And just a thing to be aware of when I'm going through this is a fairly simple one. They can be as simple or as complex as required, but the trick is not to overcomplicate it. So a simple budget that gets used is much more valuable than a detailed one that is never used. So if we flick over now, all right, so what I've got here is a couple of sheets. We've got the profit and loss budget. We have a cash flow forecast. We've got a simple cash flow chart, and then a sales and debtors worksheet, which converts the sales that you make on credit into cash. So I'll just explain a little bit more about this now. On your profit and loss budget, up the top here you have your income, your cash sales, the sales you make on credit, and interest and other income. You have your cost of goods sold, which are the direct costs associated with making these sales. Take this away from your income and you have your gross profit line here. And then down the bottom in the second half, we've just got all the expenses. These are your overhead expenses of your business, which what I've listed there is just the typical business expenses that most businesses would have, such as your advertising, bank charges, interest, insurances, postage and stationery, employee costs and travel costs, telephones, etc. And down the bottom, after taking away your total expenses from your gross profit, you have your profit before tax. All right. This is what your cash flow looks like, which is a little bit different. Again, we've got up the top, we have our cash receipts. So this is the cash coming in, and it may be from your cash sales, or it may be your collections from your customers. And this comes from the sales and debtors worksheet, which I'll go through briefly in a minute. You've also got things which I've highlighted in red are things that that don't come from your profit and loss budget, such as loan proceeds, which you might get from a bank or a financial institution, or owner contributions, so things that the owners or shareholders of the business need to put in. And that'll give you your total cash receipts. Also, what we've got up here is your cash on hand at the beginning of the month. So at the beginning of the month, you've got your cash, which is just brought forward from the closing balance of your previous month. And on the second half of this page, we've got our cash paid out, which is a lot of these things are brought over directly from your profit and loss budget. All the things in the black there, but things such as red I've highlighted. So this is something that's, for example, your PAYG withholding that you pay on a quarterly basis, which most small businesses do, but in the profit and loss they're in a monthly basis. So that's generally a fairly large variance for a lot of companies. And further down here, we've got some things in red which are not in your profit and loss budget, such as your loan repayments or any capital equipment purchases that you might make, and also your owner drawing. So if you take money out of the business at any time. And the total of these is your cash paid out. And simply, cash at hand at the end of the month is the cash on hand at the start of the month, plus your cash receipts, less your cash payments. And that'll be your cash on hand at the end of the month. Okay, another thing we've got here is a cash flow chart. And what this does, it just simply picks up the balance of cash at the end of each month. So you can see a bit more visually what your cash balance is looking like. Another thing we've put in here is just a minimum cash on hand alert line, if you like. So and what this is, it's just an amount set by you that you're comfortable with, which is just shows the line at which you want your cash to be above. So in this particular case, we've set it at $5,000. So the owner of this business is saying that, okay, when it gets below $5,000, then that's a red flag to me. I need to do something about it. I don't want to get to the point where I've got no cash in the bank. So it's a little buffer, if you like. And then we have a sales and debtors worksheet. And what this does, it picks up your sales you make on credit, and tells you when you're going to receive that cash based on history, based on the likelihood of your customers paying, and when you think they're going to pay you. In this particular case, in the yellow box here, we're saying that of the sales that we make on credit, we're going to receive 50% of that in the month after we make that sale. We're going to receive 30% 1 to 2 months after making the sale, 10% 3 months, or between 2 to 3 months after, 60 to 90 days, and so forth. And for example, you can see in July we have sales of $26,400. So we're saying in August we're going to receive half of that. In September we're going to receive 7,920, which is 30% of that, and so forth. So this just, and then this line here, the total receipts, this then flows back into your cash flow forecast. So how to set a budget? If you're starting, it's a good place to start. Look at recent history. So look at what you did last year, and use this to as a base for next year. So what I've got in here, I've just assumed that all these numbers are 1/12 of what we did last year. So I'm just going to populate this now just by carrying all these numbers over. And I'm assuming there's no sorts of seasonality or growth factored in. So just to show you a little bit easier on what's involved. You may have seasonality in your business, so that in the summer months your sales are a lot higher than your winter months. So you need to factor those sorts of things in, or growth plans and such, or different things when your rent goes up or whatever it may be. But for this example, we'll just assume that it's constant across the board. So what we're saying here is we've got a total profit for the year of $30,000 and $2,500 profit per month. If we flick across to our cash flow, what this shows is down the bottom here, we've got our monthly profit of $30,000, but our cash flow is significantly different from that, and it goes up and down a lot more for a number of factors, which I've sort of been through, that things that may not be directly in your profit and loss budget will come through at the same time. If you look at our cash flow chart, okay, so what it shows here is that you can see the big drops each quarter. That's generally when your GST due is billed. The GST bill is due, and it's dipping below that red line. So how to use this? Well, the business owner may look at this and say, hang on, cash is going below this line. What am I going to do to fix it? I'm going to have to put some more cash into the business. So he looks and he sees, okay, the worst point in time, we're $7,000 or $8,000 below that point. I think I need to put some money in the start to just provide a little bit of buffer in the business as it grows and takes off. So comes across to his cash flow, goes up the top to owner contributions, and you'll say, okay, I'm going to put $10,000 in at the start of the year. Let's have a look at what impact that will make. Okay, so it's by doing that, he knows he's going to be comfortable if he puts $10,000 in to the business at the start of the year. All else going well, he should be fairly comfortable that things will be going well for him from a cash perspective for the year. But then let's just say that in December he knows that he's going to have to buy a new vehicle for his business, and it's going to cost $20,000. So what effect will that have? So we'll go down to month of December, capital equipment purchases, and let's stick in $20,000. Flicks back to his cash flow chart and says, okay, yep, that's what I thought might happen. So looking at that, he's really going to be about $5,000 below what he wants to be at its worst point in January. So he might think, okay, I don't really want to put any more cash into the business. Let's go to the bank and see if we can get a loan. So he might go to the bank and get a loan for that, and that's all approved, and that's going to happen in December at the same time when he gets the car. So by looking at his cash flow forecast, he'll know that $15,000 is about a right amount for the loan. So he puts that in there under, oops, sorry, wrong spot. Puts that in there under loan proceeds. Got $15,000 going in there. And we can see down here what the balance is. If we go back to our cash flow chart for a quick view of that. All right, so we see that, comfortably now we're above the line. So you should be fairly satisfied that if you get to loan for $15,000, that business should be able to operate as it was. And that's the benefit of doing a cash flow forecast, is knowing well in advance of what sort of funding you might need, or what sort of issues you're going to run into from a cash flow perspective. And it's important from a bank perspective too, because if you can go to a bank, many months in advance of when you're actually going to need the cash, and have a simple explanation of why you're going to need it, what your budget looks like, banks are much more willing to be able to lend you money than if you went to them and say, okay, I'm in trouble, I need some cash now. So it's a very handy tool to have. We go back to our presentation. So yeah, so that was a very simple example of a profit and loss and cash flow forecast. And your business might need a much more complicated one, but the basics are still the basics, if you like. Some budgeting tips: set realistic expectations. And by this, I mean, don't budget to double your sales if you're not going to really do anything different in your business. Make sure you can justify it with growth plans if you are budgeting that way. Secondly, separate your fixed expenses from your variable expenses. Your fixed expenses are things that don't change with the level of sales activity, whereas your variable expenses do. So, variable expenses, by that I mean things such as your direct material costs or your labour costs or any sales commissions that you might have. And you'll need to budget for that. So if you're budgeting for your sales to increase, you need to budget for your variable costs to increase at pretty much at the same rate. Your fixed costs are things which don't change, such as you might be rent, your motor vehicle costs, or your internet, your insurances and things like that. So a lot of things in your business won't change with the level of sales activity. And they're generally sort of the overheads of your business. Categorise expenses. So by that I mean things such as, like, might be all your occupancy costs together, or your personnel costs, or your office expense costs. And just what that does, it allows you to more easily see trends in your business when you're comparing your results against your budget. Next one, allow for contingencies. That's because nothing really ever goes to plan. So consider a little buffer in your budget just in case. And lastly is check for adequacy. Will the expenses that you've budgeted for be enough to generate the sales you've budgeted for? For example, you might have a marketing plan that says you're going to visit 1,000 distributors across Australia, and this is going to help you generate $50,000 in extra sales. Well, that's all great, but you need to make sure that you've budgeted for the people required to make those extra sales, or the travel costs incurred in flying from Melbourne to Sydney to Brisbane to Hobart to 6 times for the year. So, and that's the benefit of linking your operational plans with your profit and loss budget. Gives you a better way of comparing how you're going.
Ashley, I've got a question for you from
Yep.
John in Brisbane regarding sales. John asks, how can I set my sales budget when I'm not really sure what my sales are actually going to be?
Yep. Yeah, you're never going to actually get your sales budgets right. It's, the more you do it, you can do it for 20 years and you'll still never get them completely accurate. But the more you do it, the better you're going to be at it. And having sales and marketing plans, which I talked about earlier, is a great place to start. And that's by building from the ground up. So not just plucking a figure out of the sky, but realistically building up what you think you can sell. But another point is to, especially if you're probably starting from scratch, is to do a break-even analysis, and that'll give you a bit of a line in the sand. And what a break-even analysis is the sales that you need to make zero profit. So, if you make above this level of sales, then you'll make a profit. If you don't achieve that level of sales, then you'll make a loss. I'm actually going to talk about break-even analysis shortly, so I'll explain a little bit about that in a minute.
It's fantastic. Thanks, Ashley.
Okay, so cash flow, that's all right. Cash flow forecasting tips. Compare your actual cash flow against your forecast weekly. Some companies do it monthly. Some companies need to do it daily and do it daily. Find out why there are negative variances to your forecast. Then take the necessary corrective action immediately. That might be revisiting your marketing plans and how you invoice customers or what your spending patterns are. But it's a constant thing you need to keep updating. And third point, update. So update your forward forecasts, which enables you to stay in control of your cash flow. And that's where another thing where cash flow differs from a budget. A profit and loss budget is generally set at the start of the year, but a cash flow is something that's ever changing, and you need to keep on top of it and keep updating it continually, because the more you update it, the better you're going to be at it, and the more relevant it's going to be. With the idea of you need to try to have as much cash on hand to meet all your payroll and supply requirements on time, but try not to hold too much cash than's needed. So, and by that I mean if you've got too much cash sitting in the bank, not earning interest or not doing anything, use it, stick it in some higher interest earning deposits. And by doing a cash flow forecast, you should know how long and how much you can put into those deposits. Okay, break even. Here we are. So, as I said, a break even is simply the amount of sales needed to make $0 in profit. The number of things you need to do to work out where your break even is. Firstly, is separating your fixed and your variable expenses. By doing this, you'll be able to know what your gross margin is. And what your gross margin is your sales less your variable costs. So per sale, for example. So say if you sell a pen and it costs you, and you sell it for $1, it costs you 40 cents, or it costs you 30 cents to actually buy that pen, and it costs you 10 cents per pen to actually put it into the little package you've got to sell it. So your overall variable costs will be 40 cents. So, and what that is 40%. So your gross margin would be 60% in that case, is the 60 cents in the dollar that you actually make in profit. Your fixed overheads are the things left over basically after taking away all your variable costs. So, and on the right hand side here, I've got just this simple calculation. So your gross margin, let's say from that previous example, is 60%. Let's just say your fixed overheads for the year, and your fixed overheads is an annual figure. So all your fixed overheads for the year, which is all your staff payments, your rents, your electricity, and every other little bits and pieces, come up to $30,000 for the year. That's your overhead budget. The calculation to work out what your break even is 30,000 divided by 60%, which in this case is $50,000. So that's your break even point. So if you make sales for the year which is above $50,000, then you're going to make a profit. If you don't make $50,000 worth of sales, then you're going to make a loss for the year. So that's it's a good place to start, especially if you're starting out in business or you're in the first couple of years of your business. Strong profitability and cash flow. All right. So at CFO On Call, we focus on the 7 key business financial numbers. What they are is, number one, maintaining your sales levels or revenue growth, the cost of the product or your service, the overheads of your business, your accounts collection, your inventory or your uninvoiced work in progress, your selling prices or the mix of the products and services that you sell, and your accounts payable. Now, the numbers 1, 2, 3, and 6, the purple bits, they're the things that are found in your profit and loss budget. And they're the things you need to work on to improve your profits or your profitability in your business. So, your revenue growth, the products, the cost products, the overheads, which are the 3 sort of factors that went into that gross margin. Sorry, the break-even analysis. And the 3 bits, the 3 numbers in red there, 4, 5, and 7, they're the things that directly impact your cash flow forecast. So the things that you need to work on to improve your cash position or turn your profits into cash, if you like. So they don't directly impact your profit, but they do absolutely directly impact your cash. Just going to go through now and explain a little bit more detail of these 7 key numbers. I know I'm not. I'm going to talk about the cash flow cycle. All right, cash flow cycle, which gives you an overview of these 7 key numbers. In the cash flow cycle, everything of those 7 key numbers is in there in one way, shape, or form. All right, what it is. Let's say we buy stock on day 1. Let's say we sell that stock on day 101, so about 3 and a bit months after you buy it. We've got trading terms with our supplier, and we have to pay for that stock on day 46. What that means is we have 55 days of negative cash flow. So the time between paying for the stock and selling that stock. Let's say we get paid for selling it on day 217. So about 4 months from the time that we actually sell it. That's a further 116 days of negative cash flow. And overall, 171 days of negative cash flow. So 6 months between the time that you have to pay for the stock to the time you get paid for it. Now you might look at those numbers and say, oh, okay, that's a bit exaggerated, but it's actually not. It's pretty typical of a business which isn't quite ran as well as what it could, and it's probably pretty average on an average business out there. And when we talk about growth and the problems you can run into with growth, this is why. Because if you sell, you're aiming to sell an extra $100,000 of product this year, and your margin's 50%. What this means is you've got to find $50,000 for 6 months of the year. You've got to find $50,000 to make that $100,000 in sales before the money comes in. So, and a lot of businesses don't plan for this when they're doing their profit and loss budgets. They need to plan for it, and cash flow forecasts help you do this. All right, number 1, sales revenue growth. So business owners focus a lot on sales. Let's make more sales, and profit will look after itself. Yep, winning a job is important, but what is just as important is how much that job costs you to make and costs you to fund, which I've just sort of mentioned. So have a plan on how you're going to maintain or grow your sales revenue. You need to measure your revenue drivers against your budget, whether it be salesperson, advertising spend, or product offerings. And then, if these drivers are varying from what your budget is, change things to suit. So change your salesperson, etc. And then go back and do it all again. So it's an ever evolving thing. You got to keep looking at things. Cost of your products or service. Reducing the cost of your product or service can be done in a number of ways. Negotiating with suppliers, looking at alternative materials to get better prices, focusing on direct labour costs, so your scheduling or your overtime, outsourcing or capital investment. So, you might need to buy a new bit of equipment, and by doing that, it's going to allow you to not work as much overtime, for example. So creating efficiencies in your business. And the cost of your product can have what's important is the cost to know and understand is the cost of your product can have a bigger impact on your profit than simply increasing the sales volumes or the price of your sales, the products that you sell. Number 3, reducing overheads. Reducing overheads is just a bit of hard-nosed cost control, and every business needs to do it from time to time. It's often a cost in the business that's not really challenged. How to challenge it? We'll look at your costs on a line-by-line basis. Challenge the necessity of each cost item. Is it necessary? Is it excessive? Is it increasing or decreasing? We'll also include overhead people. Oh, hang on, sorry, go back to that one. Okay, yeah, so, and I've been asked in this webinar previously, which is a really good question, so I'll bring it up again, is what should you cut from your business, from your overheads, and what shouldn't you cut? And as a simple way of explaining it, cut your fat but not your muscle. So don't stop the things in your business which is making you money. don't stop the marketing if the marketing's working for you, or don't get rid of good staff if they're helping you to make sales or to improve things in your business. But things to get rid of are the things that you don't need, such as you might have 6 mobile phones and 4 of them aren't really being used, and you're on this plan that's 6 years old and you're paying a fortune for it. And that's what a lot of businesses have, because they don't challenge it and look at it at each time. So cut the things out of your business which isn't actually doing your business any good. Number 4, improve accounts collection. Your business should not be financing your customer's business, first and foremost. And that's really how you should look at it. If your customer isn't paying you, then they're using you as a bank. It's a systematic thing, accounts collection, and it should be done on a regular basis. A lot of the times it's done weekly. It involves reviewing what your outstanding accounts are, establishing a collection strategy, invoicing as soon as possible. So as soon as you've done the job or made that sale, invoice it out then and there. It's a lot easier to collect if it's timely in someone's hands. So if you invoice someone 3 months later, they're less likely to pay you straight away than if you invoice them the day you actually sold it. Collecting the outstanding monies. Sorry, I'll go off track a bit. So collect those outstanding monies. Identify your problem customers. Review your terms and conditions, and possibly even establishing a settlement discount policy. So, and by that I mean, if someone pays on time or by a certain date, it might be they get 2% off the price. But this should also always be done in conjunction with your price setting. Reducing inventory and work in progress. Okay, in many industries, inventory levels or your uninvoiced work in progress are major issues. Improvements in this area is normally done by looking at your stock levels and the value of each item, looking at the sale or usage levels of these items, and establishing strategies to remove old stock from the business. So by that you could stick it on eBay or a multitude of sites out there that offer products at reduced prices. It's a good way of getting rid of stuff that isn't actually going to impact the sales of your current items that you sell. Looking at the value of uninvoiced work, need to look at whether your contracts take into account the cash flow of your project, and ensure that future contracts, if not, are structured to take this into account. So, and can even be structured by a cash flow positive, from a cash flow positive point of view. By that I mean, do your contracts, do they have in there that a customer needs to pay a deposit? Is there milestone payments along the way? So, when you get to a certain part of the job, they need to pay 50% and then 30%, 20%, for example. And this, could be structured so that you actually receive the cash in before you actually need to pay out the expenses in relation to that. So you're in a cash flow positive position all the time. And especially with jobs a job costing environment, make sure you've got systems in place to enable you to manage when these things need to be invoiced and how much progress you've made in each job. And just lastly, finish jobs as soon as possible so they can be invoiced. Reviewing your pricing. So this doesn't need to be a published price or an increase to all of your customers. Then there are numerous ways you can prices can be increased without necessarily damaging your reputation or your business. Normally done by looking at the pricing of each product or service or group, reviewing the sales levels of these services or products or groups, and looking at the cost of the services, identifying the best or the worst products in terms of profitability, and implementing a pricing strategy or a system. And could include a structured pricing strategy based on customer type or service offering, to ensure that your best customers or services are promoted, and your less profitable customers or services are less promoted or may need a higher price increase. and do it regularly. So small price increases are often better than a large infrequent ones. And small price increases in many businesses just are just expected and just happen. And you need to understand that if you don't increase your prices, all your suppliers are increasing their prices to you. So you're going to create it's going to create a margin squeeze. So your gross margin is going to come down, down, down. So the actual amount of sales you need to make to overcome this is going to be more and more and more, and your profit's going to be less, less and less. So you need to understand what your pricing is and increase accordingly. And again, I've been asked this a number of times. Will it affect my business? Will I lose customers because of this? Um, and my answer to that is not necessarily, and probably not. No, and you shouldn't. You should use that time to ask yourself, where will they go, and use it as a way of promoting your unique selling proposition to them. So, what makes you different from your competitor, and what are the value add services that you provide? Review your accounts payable. So again, this is an area that can result in big improvements to your bank balance. It's normally done by looking at your payment terms with your suppliers, ensuring these terms match the cash flow of your projects. If they don't, sit down with your supplier and explain your cash flow cycle. Work out a way that these can be matched. Increase your payment terms for different products or alternatives products that may suit both you and your supplier's business better. And try to seek a more collaborative type relationship with your key suppliers, because an increase in your business is going to flow through and have a positive impact in their business, because it's going to increase their sales. All right, just to summarise the 7 key numbers. Almost every business owner can make small improvements to each of the 7 key numbers in their business. Each small improvement to the right numbers, often by as little as 1 or 2%, when calculated together, can have a massive impact on the total cash flow and profit. A typical poorly managed business from a financial perspective, with revenues of around $1 million, could realistically improve annual profit by $50,000 or $60,000 and improve their cash flow, or cash in the bank, by $100,000. And that's, it's not an exaggeration. If your business isn't run quite as good as what it could be from a financial perspective, putting little things in place can have a massive impact. So what do successful businesses do? They have a business plan and a budget, which is your financial roadmap. They're systematic. They measure their performance, usually monthly. If their measurements don't meet their plans and their budgets, they make changes to their business. And largely because of this, they have strong profitability and they have strong cash flow. And you need to remember that setting goals is only part of the journey. So business must always adjust and aim to develop flexibility and respond to challenges and opportunities as they arise. And what a budget and a cash flow forecast does, it gives you a greater understanding of your business and increases that flexibility so that you can adapt to the changing environment. If you don't have a budget and a forecast, you're not going to understand your business well enough to be able to be flexible and have the confidence to change it when you need to. Okay, just as a bit of a recap to finish off what we've covered today, we've looked at why each and every business needs a budget and a cash flow forecast. Been through an example of a profit and loss budget and a cash flow forecast, and we've talked about the 7 key financial drivers of your business. On the left-hand side, we have the things that impact your profit, your profitability, being your revenue growth, your sales prices, the cost of your goods and your services, and your overheads. And on the right-hand side, the 3 factors that are critical in turning those profits into cash, which is your accounts receivable, your accounts payable, and your inventory or your work in progress levels. I'll just hand you back to Sue and she can talk about our offer for you today.
Thanks, Ashley. That was great. A great explanation of what can be seen as a bit of a complicated exercise. So we'll stay on the line for a few minutes for any questions. So if you'd like to just type them into the panel on the right-hand side, Ashley will be happy to answer those. And as a thank you to our audience today for participating, we'd like to give you a free template of the budget and cash flow forecast that Ashley used in the example there. So that'll be emailed to you. We've also got a special offer of a financial roadmap prepared for you by one of our CFO On Call advisors, because it can be quite a time consuming job if you're not doing them all the time or you haven't done one before. So it can be quite helpful to have somebody with expertise to ensure that you include everything. So the offer today is a fixed fee of $395, including GST, which is a really great deal. So if you'd like to take advantage of that offer, please give us a call on the numbers on the screen. We've recorded the webinar today, so we'll send you a link to the video. So if you're a little bit late arriving, don't worry. And so you'll be able to recap the video. So look out for any other webinars coming up, for example, on the 7 key numbers that drive profit and cash flow. We've also got lots of articles on our website on issues relating to financial control for small businesses. So feel free to visit the website and read those articles under the news heading. There's also some free ebooks that you can download. So go and have a look at those. And can I make a suggestion today that immediately that you log off after this webinar, that you put some time in your diary to work on your own financial roadmap? It's a well-known fact that much of what we learn doesn't get implemented unless we commit to it. So thanks again for joining us today, and we trust that you've enjoyed the webinar and take away some valuable lessons today. And enjoy the rest of your day, and I hope it's a profitable one with fantastic cash flow. So thanks again to you, Ashley, and thanks to the audience.
No worries. Thanks, guys.
Have a great day. Bye.
Ciao.